Hello, everyone, and welcome back to the Peterson Institute for International Economics. We are closing out our Macro Week 2024 with perhaps the most widely anticipated of the events. We had an address and discussion today with Reserve Bank of India Governor Das. This is the first time, I believe, we've had Governor Das to the podium, although we have had one or two of his predecessors, and we're very delighted to have him with us. As some of you have heard, both in person and online over the past week, a major emphasis of the Peterson Institute's both convening agenda and research agenda for the coming months is the role of what we are calling, for the time being, third nations, meaning those large or significant influential economies of like-mindedness who see a stake in a orderly, relatively open, relatively free global economy, but who are not the US and China. Notwithstanding the events of the upcoming US election, it is sad but realistic to say that whoever wins the US-Chinese conflict will not be going away anytime soon. And it is sad and realistic to say that though we can always hope, and the Peterson Institute will continue to advocate for such, we are not likely to see a U-turn back to rapid leadership of the US in the economic system. For this reason, as I quoted various esteemed Americans at the WTO last month, it is time for China and the US to lead, follow, or get out of the way. If they get out of the way, one of the most significant actors remaining on the stage is, of course, the Indian economy, its leadership, and its civil servants, including notably Governor Das. And it's in that regard we welcome him today to the Peterson Institute to address the G20 and international monetary agenda, economic and financial fragmentation, central banks and climate change, and of course the success story that is the Indian economy in recent years. Mr. Shaktikanta Das is the governor of the bank, but he is also notably a career civil servant with over 43 years of service in India, particularly in the areas of finance, taxation, and infrastructure. He served as Revenue Secretary and Secretary of Economic Affairs for the government. He has played a key role in major developments, including the Goods and Service Tax and the Insolvency and Bankruptcy Code, both of which instituted in recent years, and as well as the introduction of the flexible inflation targeting framework, which I believe the Reserve Bank follows to this day. He has previously served as a director in the Central Board of the RBI, and he has been on the board of he is currently on the board of Securities and Exchange Board of India, the regulator for the country's capital markets. He has served on a number of international commissions and institutions and has represented India in several fora, including the IMF, the G20, the BRICS, and has acted previously as India's G20 Sherpa and was member of the Finance Commission. But of course, he is now the governor of the Reserve Bank of India, and is in that role we welcome him to the Peterson Institute stage. Governor Das, if you would, please.
Thank you very much for that introduction. Dr. Adam Posen, ladies and gentlemen, I'm extremely delighted to be here today at the Macro Week 2024 organized by the Peterson Institute for International Economics. The Institute has established itself as a leading forum bringing together public policy practitioners, central bankers, industry leaders, research professionals, and scholars to brainstorm on emerging macroeconomic issues. Such discussions, especially on the sidelines of the International Monetary Fund and the World Bank meetings, provide fertile ground for rigorous and meaningful interactions on matters of contemporary policy relevance. In my remarks today, what I have done is that I propose to share some of my thoughts on the international monetary agenda and its relevance in a world confronted with economic and financial fragmentation. I shall also touch upon why and how climate change needs to be a part of central banking narratives. Let me first focus on international monetary agenda. The global economic dynamics is shifting rapidly, driven by forces such as technological transformation, geoeconomic realignments, environmental challenges, and the ongoing global geopolitical disruptions. In this rapidly changing context, it is incumbent upon G20 and the international monetary and financial institutions to adapt swiftly and act decisively to foster global stability and sustainable growth. I would like to highlight 6 areas of priority in this context, not necessarily in order of their importance. The first and foremost priority at the current juncture should be accorded to reforming the international financial architecture. This involves prioritizing inclusive global governance frameworks that better reflect the realities of today's global economy. The current system, while foundational, needs to reform itself to ensure equitable voice and representation for the emerging economies. Enhanced access to resources and stronger role in governance of institutions such as the IMF and the World Bank will not only enhance the legitimacy of these institutions, but also foster more serious global cooperation in addressing the macro-financial challenges that we are confronted with today. Second, that is the second priority I would like to highlight is with regard to the agenda, which should be, I feel, the debt restructuring mechanisms. While the G20's debt service suspension initiative, that is the DSSI, and the common framework for debt treatment were commendable measures, the scale of the problem is, however, much larger. Debt restructuring processes remain ad hoc, slow, and on several occasions not sufficiently transparent. This results in protracted crisis, causing unnecessary economic suffering for the debtor countries. We need an overhaul of the debt resolution architecture and its refashioning into one that involves both public and private creditors. And also it ensures timely debt restructuring and links debt relief with sustainable development objectives. Without such reform, the vulnerable countries will continue to face unsustainable debt burdens, which will have repercussions for global financial stability. Third, we must recognize the fragility and the fault lines of the global monetary and financial system, both institutions and markets, that is both at the level of institutions and also in the markets. Recent years have highlighted the risks posed by financial instability in both advanced and emerging markets. There indeed is a pressing need to improve global financial regulation to manage systemic risks posed by private capital and non-bank financial intermediaries, which now hold a significant portion of the global assets. The rise of shadow banking and fintech and the growing footprint of decentralized finance require more robust regulatory oversight to prevent contagion effects and ensure financial stability as a global public good. The fourth area of concern is the digital divide that I'm now going to highlight. As the global economy becomes more decentralized, countries that lack the infrastructure, skills, and the regulatory frameworks for digital inclusion risk falling further behind. The G20 and the international monetary and financial institutions should work towards nurturing an ecosystem that promotes investment in digital public infrastructure and widespread adoption of digital technologies while ensuring cybersecurity and privacy safeguards. Fifth, geopolitical tensions are increasingly affecting economic policies, leading to sanctions, weaponization of finance, trade restrictions, and supply chain disturbances. This is causing economic fragmentation as countries aim for strategic independence in key areas like energy, technology, and strategic materials like semiconductors and critical minerals. The G20 must play a critical role in preventing further economic fracturing by promoting open and rules-based trading systems. While recognizing the need for countries to secure their supply chains in tactically important sectors, the G20 should foster cooperation in areas such as technology transfer, investment in global public goods, and green transition. Sixth, and perhaps above all, climate finance must be at the forefront of G20's priorities and the international and also should be a part of the international monetary and financial agenda. The international financial system must mobilize significantly greater resources to fund the transition to a low-carbon economy. The G20 must also coordinate national efforts to ensure that climate policies do not lead to protectionism, unilateral trade barriers, or trade conflicts. The rise of border carbon adjustments, that is BCAs, and similar measures must be managed through cooperative frameworks to avoid unnecessary economic fragmentation. Additionally, there is an urgent need for innovative financial instruments that can incentivize private capital to flow into climate-related efforts. Without a fundamental shift in the way international monetary and financial systems address climate finance-related issues, we risk exacerbating environmental degradation and global inequality. We live in now I have highlighted 6 areas of priority which should be the agenda, I feel, for the G20 as well as for the international monetary and financial institutions like the IMF, the World Bank, and others. Now, we live in an era of high uncertainty and turmoil, where the job of policymakers is something like steering a vast interconnected fleet through turbulent seas, where the old maps no longer suffice. The time for incremental changes has gone. What is needed now is a transformative action agenda which should ensure that the global economic and financial architecture serves all nations and peoples and not just a select few. With collective action and renewed commitment to multilateralism, we can build an international monetary and financial system that is truly fit for the 21st century. Let me now turn to the next area, the second area which I wanted to highlight, and that relates to economic and financial fragmentation. Global cooperation and the integration of global markets in particular were instrumental in driving decades of world growth. For many low-income countries and emerging markets, this integration into the global economy was a crucial contributor to their development. It provided them access to affordable imports, extensive export markets, and foreign technology. Now, however, geoeconomic fragmentation is weighing on the outlook for global growth. The geopolitical risk index has spiked sharply in 2024 amidst increases in trade restrictions and financial sanctions. This has reversed the substantial benefits from global economic integration that we have experienced in the past decades. There are now fears of deglobalization and increasing regionalization. This could dampen the convergence of emerging and developing economies to better living standards. Geopolitical risks are also imparting heightened volatility to capital flows and asset prices. They are also undermining the efficiency of global payments systems. Cross-border flows of goods, services, and capital have leveled off since the global financial crisis 2008. Recent geopolitical events have further fueled protectionism alongside an increase in trade and logistics disruptions. For many low-income countries and emerging markets, potential losses due to deglobalization could be much greater. Despite these downside risks, it is heartening to see recent projections which suggest that global goods trade could post an increase of 2.7% to 3.1% increase this year. The WTO's projection is 2.7%, and the projection made by the IMF with regard to the volume of global trade in the current year 2024 is 3.1%. So by and large, it is expected to be around 3% in the current year, and this is on the back of the previous year where the growth in global trade was just about, was marginally positive. Even as this near-term resilience gives hope, remaining alert to changing winds is important while preparing for an increasingly uncertain outlook. Recently, global value chains have also seen significant disruptions due to both geopolitical events and overarching issues like the pandemic and the climate crisis. This has raised concerns regarding the reliability of global value chains as engines of growth. Discussions regarding friendshoring and reshoring are spreading dissonance and fears of discriminatory measures against foreign competitors. In such a trade environment, it is the bystanders that would be disproportionately affected. Other forms of fragmentation, like technological decoupling and disrupted capital flows, would also have their adverse effects and raise costs. They can also impact funding costs of banks and domestic financial institutions, reduce their profitability, and prompt them to contract lending with potentially adverse effects on economic activity. Building up adequate international reserves as well as capital and the liquidity buffers within the national financial systems would be vital to reduce the vulnerability of emerging market economies to such adverse external shocks. Finally, there is the apprehension that if geoeconomic fragmentation continues unabated, countries may seek to become less reliant on international financial infrastructure and global standards. Fragmentation of the international monetary system could have serious implications for markets. New parallel systems that lack interoperability may emerge, which means higher transaction costs and other inefficiencies. Strengthening crisis preparedness to deal with the fallout from these tensions, including the unanticipated ones, should be a policy priority for emerging market economies. The global financial safety net must be reinforced through mutual agreements between countries. This may include regional safety nets, currency swaps, fiscal mechanisms, and precautionary credit lines from international financial institutions. If these things do not happen, emerging economies will have to substantially augment their own safety nets and buffers. Finally, let me turn to central banking and climate change. Traditional views on climate change policy have given way to a more updated multi-regulator approach to tackle the unfolding repercussions of extreme climate events. Manifestation of these risks through demand-supply shocks, productivity losses, asset revaluations, and transition to a low-carbon ecosystem at high cost can impair financial, monetary, and price stability. To my mind, the question, therefore, is not whether central banks should take into account climate change, but how should this consideration be integrated to their central mandates. This involves first understanding the impact on price stability given the high costs and other transition risks involved in progressing towards a low-carbon economy. Second, it is important to assess the impact on financial stability in all its ramifications. Third, it is necessary to balance macroprudential responsibilities to help financial institutions to manage material risks associated with climate change. Fourth, robust analysis and research are needed to enable advocacy and thought leadership in this space. The Reserve Bank of India does not have an explicit remit or an explicit mandate for dealing with climate-related risks. It is, in fact, an inferred responsibility derived from the Reserve Bank's macroeconomic and financial stability mandates. This has encouraged our quest for suitable instruments and actionable frameworks. The Reserve Bank of India has set up a sustainable finance group within the bank and has also joined the Network for Greening the Financial Systems, that is NGFS, in the year 2021. Some of the steps already taken by us include promoting green finance initiatives such as the inclusion of finance to renewable energy projects in directed lending, that is what we call priority sector lending by banks, issuance of sovereign green bonds, and establishing a framework for acceptance of green deposits. This also includes developing a disclosure framework on climate-related financial risks and guidance on climate scenario analysis and stress testing. At the cross-country level, I believe it is important to give due acknowledgement to the sharp trade-offs central banks face when dealing with climate-related risks. On the one hand, central banks have to operate within the confines of their specific legal frameworks as publicly accountable institutions. But at the same time, they have to provide rigorous evidence in support of all their actions. On the other hand, central bank balance sheets might already be exposed to climate-related risks, and they may be forced to respond to them from behind the curve. While recognizing that government is the most appropriate and effective authority to spearhead climate action, each country, based on its domestic conditions, has to decide between having explicit climate mandate for the central bank or subsuming it into its price and financial stability mandate. So central banks in most of the countries at the moment do not have climate risk management or climate-related activities as part of their legal mandates. So the way we have done it in Reserve Bank is that we have derived it from the mandate which we have for maintaining price stability and financial stability. But there is no specific legal provision for that. We have derived it from the broad theme of maintaining price stability and financial stability. But that we have done in the conditions that prevail in India. Other countries' central bank, other countries' central banks may require or may decide to have a specific legal mandate vested in them by their respective legislatures and governments. Now let me try and conclude. As I conclude, let me briefly speak on the Indian macroeconomic experience in the recent years. The Indian economy rebounded from the severe contraction imposed by the COVID-19 pandemic and averaged a real GDP growth of above 8% during the last 3 financial years. For the current year, 2024-25, the Reserve Bank of India has projected real GDP growth of 7.2%, with risks evenly balanced around this forecast. And in its, in its macroeconomic outlook, economic outlook report, the IMF 2 days ago has projected India's growth in the current year at 7%. Our projection is little higher at 7.2%. Improving domestic demand, lower input costs, and a supportive policy environment are spurring manufacturing activity. The services sector has also been displaying strong growth. The overall growth outlook reflects the underlying strength of India's macro fundamentals with domestic drivers, namely private consumption and investment, playing a major role. The government's thrust on capital expenditure and healthy balance sheets of both banks and corporates are expected to support private investment. In fact, there are already visible signs of private investment reviving. Private consumption, the mainstay of aggregate demand, also appears to be on track for a strong improvement due to favorable agricultural outlook and the pickup in rural demand. Sustained buoyancy in services is also expected to support urban demand. Resilient growth has given us the required space to focus on inflation so as to ensure its durable descent to the 4% target, which is the legally mandated target for the Reserve Bank of India. And in our target, we have a band around the target. The target is 4%, but there is a band of 2% plus and minus on either side. That is, it should be in the range of 2 to 6%. Failing which, if it fails to happen for 3 consecutive quarters, then it is treated as a failure of monetary policy, and that would require the Reserve Bank to submit a report to the government explaining the circumstances in which it happened and what is the plan of action that the Reserve Bank has. So that gives some amount of flexibility to our policy making because of the band which is there around our target of 4%. But 4% is the target. And we are not, the effort is not just to remain within the band, the effort is invariably to align inflation to the target and remain as close as possible, on the target, to the target. The headline inflation trajectory is now projected to sequentially moderate from the last quarter of this financial year. Unexpected weather events and worsening of geopolitical conflicts constitute major upside risks to the inflation outlook. Immediately in the aftermath of the war in Ukraine and the sudden restrictions on energy availability of crude oil, availability of edible oil, wheat, all these things in the international market, there was naturally a lot of pressure on our domestic inflation also. And now, for example, in cereals, India does not import wheat. We are self-sufficient in wheat. But when international prices of wheat go up, when the war started in Ukraine, when the international prices of wheat went up, since India is a part of the global market, and India also exports cereals like wheat, from time to time. So naturally, domestic prices went up. Then edible oil, I'm just giving a few examples. Edible oil like soybean oil or sunflower oil, which is consumed in India by a large number of households, that also the prices went up because a lot of it come from that Caspian Sea region, from those parts of the world. So our consumer inflation suddenly spiked to 7.8%. But thanks to the the monetary policy action which we have taken since then by taking out liquidity, a process which had started well before the outbreak of the war in Ukraine, and the rate increases which we did in a very calibrated manner, and also assisted by and helped by the supply side measures taken by the government, inflation has indeed come down. And in fact in the months of now July and August, it was below 4%. It was 3.6 and 3.7. Now July, it was below 4% primarily because we had a huge base effect advantage. August, actually we had the base effect advantage. We didn't have an advantage, we had a marginal disadvantage. Notwithstanding that, the inflation, consumer price inflation was 3.7%. But then, because of certain weather events and rise in vegetable prices, and in India, the food component in our CPI basket is as high as 46%, and in that, vegetable prices and certain cereal prices have a considerable weightage. So therefore, because of adverse seasonal conditions, untimely rains, etc., the vegetable prices went up, and we had projected the September inflation to go up, and it has gone up, it has crossed 5%. October also we expect the inflation to be high, but after October our projections are that the inflation will begin to moderate. So on the whole, inflation is moderating in India, but we cannot take it for granted. There are still risks arising from unexpected weather events, unexpected fresh geopolitical developments, and supply chain bottlenecks should they materialize. So broadly, therefore, growth is well sustained. and inflation is by and large, it's under control and it is moderating. A continuing priority for the Reserve Bank of India has also been to strengthen the financial sector. The health parameters of banks and non-bank financial companies, what you call as NBFIs, are now very robust. This has resulted in sustained credit flows, especially to the remote and underserved segments, bolstering financial inclusion. In fact, the health of our banks, both government-owned banks as well as private banks, and the health of the non-banking finance companies who are also lenders, large lenders in the credit market, their health today is their overall financial parameters today, performance indicators today are much better, much stronger than they were before we entered the period of the COVID-19 pandemic. So therefore, the financial sector in India has not only emerged largely unscathed, but has emerged stronger from the last 4 years of multiple crises. As I said in my last monetary policy statement, and I'm now concluding, as I said in my last monetary policy statement on 9th of October, earlier this month, today, the Indian economy presents a picture of stability and strength. The balance between growth and inflation is well poised. The external sector demonstrates the strength of the economy. Forex reserves are scaling new peaks. Financial consolidation is also underway on the part of the fiscal authorities. The overall financial sector remains sound and resilient. Global investor optimism in India's prospects is perhaps at its highest ever. But even in this scenario, I would like to emphasize that we are certainly not complacent, especially amidst the rapidly evolving global conditions. We maintain our vigil and always stand ready to identify, to make our best effort, to put in our best efforts to identify any possibility or potential risks and try and deal with them as proactively as possible. So we are vigilant and we are certainly not complacent and keep on monitoring the evolving global conditions like so many other central banks. I'll stop here. Thank you very much.
I invite you to sit. Thank you very much, Governor Das. Both this week and in history, the Peterson Institute podium has had very substantive presentations by central bankers, but you actually gave us enough material for 3 separate speeches, and I am grateful to you for setting a new standard for substance. If I could, before opening it up to our in-person audience, I'd like to go through, essentially in order, some follow-up questions to you on each of the 3 components: the international agenda, climate change and central banking, and then the Indian outlook. First, on the international agenda, you listed 6 points, and I'd like to ask you to expand a little on the second, which was the issue of international debt. And I think any fair observer would agree with you that despite the progress made with the common framework, we have, as the World Bank and others point out, a debt crisis. We have a bunch of countries that were set back by COVID and the interest rate cycle and have not gotten out. Could you say a bit more about what you think are feasible, useful steps that either the G20 or the IMFC or some coalition could pursue to alleviate the debt situation? And longer term, is there a different world?
So there are 2 aspects to the problem. One is the need for multilateral effort. The other is effort on the part of individual countries, individual economies. Now, countries which have high debt and also high fiscal deficit in their budgets year after year. They need to sort of bring back their fiscal path, they should bring it back on the rails, and they should resort to a fiscal consolidation path. And the fast path of fiscal consolidation is not easy because the economy and the larger cross-section of the people, they get used to certain, loose, fiscal support, certain allowances or certain, check payouts, etc. So fiscal consolidation, each country must adopt and has to back it up with appropriate communication. It has to be explained to the people that for the long-term sustainability, I'm talking about individual countries, that for the long-term sustainability of the economy, for the long-term well-being of the economy, it is necessary that the economy, the budgets of those states should, the finances of those states should come to a path of bringing back fiscal consolidation as the mainline agenda. Now that is a very tough call which each country must make, but there is no choice. It has to be done. So far as India is concerned, just by way of a little digression, I can mention that India is on a fiscal consolidation path. A roadmap has been announced, and the government is adhering to that fiscal consolidation path. So talking at the global level, so the first is individual countries will have to adopt this fiscal consolidation path. Here, the uniqueness of the problem this time around is that it's not just emerging market economies, not just low-income countries, but some of the advanced economies also have, high fiscal deficits and very high government, I'm talking about public debt in particular, very high public debt. So therefore, those economies in the advanced part of the world should also address these issues. And it calls for coming back to the fiscal consolidation path, communicating it appropriately to the people, and also reprioritizing the quality of expenditure, moving more towards, infrastructure spending, moving more towards developmental expenditure, which have greater multiplier effects. So that is at one level. The other level is the need for multilateral effort. Now, some of the low-income countries, their fiscal capacities are very, very limited. Now, unless there is a global effort, either through, it has to be through the IMF or it has to be through the G20, but ultimately the IMF has to lead this whole thing. And there has to be, sort of global support involving both private creditors as well as multilateral creditors and government creditors to restructure the debt, especially in respect of the low-income countries and the emerging markets, the small emerging market economies. So therefore, it has to be a two-pronged approach. And the problem is actually quite serious because at the current juncture, the global debt is assessed by the IMF to be as high as 93% of the global GDP. And it is projected to reach 100%, I think in 2027 or 29, in a very near future. So it is a real problem, and there has to be a two-pronged approach, as I explained.
Thank you. As you explained, it's not easy, but it has to be done. Another piece on your list of 6 measures on the agenda for the international monetary financial community was concerns about the potentially destabilizing effects of crypto, of other alternative currencies, fintech, you mentioned fintech specifically, in the fragmenting world we're in. Again, could I ask you to expand a bit on that? What do you have in mind as the threats? Where are we on the international agenda in dealing with that?
You see, in the G20 under Indian presidency, there was an agreement to develop an international understanding, understanding with regard to how to deal with this whole crypto ecosystem, which is now developing. And it has made some progress. The FSB has come out with certain framework for disclosures, etc. But I think more work still needs to be done. From India, from the Reserve Bank's perspective, I think we are one of the first central banks which very clearly voiced its serious concerns about the so-called cryptocurrencies, because we see them as big risks, huge risks to financial stability. And there are good reasons why we are saying that. In fact, we see it has got, first we have to understand the origin of cryptocurrencies. The origin was to sort of bypass the system. Now, it's a question, the fundamental question here is, cryptocurrencies have all the qualities of money. The fundamental question is, are we as authorities, are governments comfortable with privately issued cryptocurrencies which have all the features of currency? Currency issuance is a function, is a sovereign function. So bigger question, larger question is whether we are comfortable with crypto, which has characteristics of being a currency, whether we are comfortable with that to have a private currency system in parallel to the fiat currency. Obviously, if a certain part of your economy is getting carved out and it is dominated by the crypto assets or the private crypto assets, then the central banks lose control over the entire monetary system. So therefore, it will lead to huge amount of instability in the monetary system. It can also promote huge amount of instability in the financial sector. So there are very big risks. So therefore, in India, we have been articulating that it has to be a very, very careful, we have to deal with this very carefully. In fact, we have articulated that, countries, of course, it will depend on individual countries taking their own decisions, but we feel that it has to be very strongly, it is something which is, I think, should be very cautiously and very carefully dealt with. And I am actually of the opinion that this is something which should not be allowed to dominate the financial system, because it has huge financial stability risks, it has huge monetary stability risks, it also poses risks to the banking system. It also may create a situation where the central bank may lose control of money supply in the economy. And if the central bank loses control of money supply in the economy, how does the central bank, check liquidity available in the system, and how does a central bank control inflation by squeezing money supply or by, loosening money supply in times of crisis? So we see crypto as a big risk, and there has to be an international understanding because the transactions are cross-country. So there has to be international understanding on this issue, being fully mindful of the huge risks associated with cryptocurrencies, and it is not something which I feel, it's not something which should be encouraged. This view is not a very popular view, but I think as custodians of financial stability, it is a major concern for central banks world over, and governments are also becoming increasingly aware of the possible downside risks in cryptocurrencies.
Thank you very much, Governor. I just want to say, whatever the views of our global audience listening worldwide, as well as our friends here in person, this is a very important statement by the governor, because as far as I have known, the general thrust and direction of travel among central banks has been primarily encouraging or at least benign neglect of these developments. And I think it is, again, whatever side you're on, I think it is very important to have the governor of the Reserve Bank speaking frankly on this and reminding us that it is not all one way. So thank you for that, Governor.
And just one sentence I would like to mention. If you read the news items which appear relating to cryptocurrencies in the media over the last 2 or 3 years, I think mostly the news are not too, not too welcome news, and most news reports are quite negative about how cryptos have created, various situations.
We'll look forward to further exchange and convening on this issue, frankly, here at Peterson. Turning to the second piece of your very rich discussion, Governor, climate change and monetary policy, climate change and central banking. You took us through, and I appreciate you're making very clear about how the Reserve Bank of India interpreted its mandate, and other countries, other central banks may have different ways of getting there. But I feel like you mentioned a number of things, but there's one piece that I didn't quite understand, which is, how do you integrate your concerns for climate change into the flexible inflation targeting framework? Is it that it's all done on the financial stability side and these are separate issues? Is it that you treat shocks, say there's a succession of carbon price increases, which from a climate change point of view would be a positive thing probably. Do you treat that separately in inflation targeting? Do you define the target differently? Could you just say a bit more about the monetary policy side of dealing with climate change?
You see two aspects to it. One, climate-related risks as a risk to financial stability, you mentioned about that. The second aspect, specifically with regard to price stability. Now, how sort of climate change is linked to flexible inflation targeting and our mandate to maintain price stability and inflation targeting. Now, what happens is that I just mentioned about the weather-related events, right, and the weather-related events and huge climate shocks, which can happen in any part of the world, as we have seen in the recent years. I mean, there are untimely huge floods, there are rains, there are forest fires, and all kinds of disasters are taking place. Now, how much of it is directly related to climate change is another issue that's for scientists and researchers to come out with. But nonetheless, there are extreme weather events which are taking place, and many of it are by and large related to the climate change. Now, if that happens, it will have repercussions on the balance sheets of the financial institutions like banks and the other credit institutions. So if the balance sheet of the banks, etc., get affected, then monetary transmission to that extent will become problematic, in the sense that the banks, the monetary transmission takes place by way of what are the government bond yields, what are the bank lending rates or the bank deposit rates, and what is the interest rate in the overall credit market. So unless you have a strong credit, institutions, whether banks or non-banking lenders, monetary transmission to that extent will get affected. So therefore, what we have done is that we have issued certain discussion paper relating to assessment of climate risks, and we have also encouraged the banks and non-banking financial lenders to undertake their own stress tests with regard to assume extreme weather events and under various scenarios do stress testing of their balance sheets. So therefore, we need strong, robust financial sector, which is again dependent on their ability to do, their ability to recognize the risks, their ability to do the stress testing, and keep these institutions in a robust condition to ensure better monetary transmission. And some of the climate-related risks immediately have impact on, some of the weather events have immediate impact on food inflation in particular, and particularly for countries like India and many other emerging economies where the food component in the household consumer basket is quite high. I think this is also very important with regard to the private sector players and everyone to manage the the logistics and the supply chain arrangements to overcome the climate-related situations.
Well, thank you. I will turn to our in-person audience for questions in a moment. One last question from me, again, in your third leg, talking about the Indian economy, but relating to your remarks. You mentioned how, for example, India is self-sufficient and even at times exports wheat, but global developments in the wheat market meant that prices went up. My understanding is that there is some public discussion about altering the inflation target in India to exclude food. How does the Reserve Bank think about this? I mean, if we live in a world of not just climate, but increasing numbers of shocks, perhaps exacerbated by fragmentation, as I rightly argued, does that change how the Reserve Bank should manage inflation or think about it?
I'm happy that you asked that question. You see, flexible inflation targeting was adopted in India by an amendment to the Reserve Bank of India Act in 2016. In fact, this is a major structural reform of 21st century India. Together with the goods and services tax, which was a nationwide indirect taxation levied on sale of goods and services, because before that we had central, federal level taxes, and again we had state level taxes, provincial level taxes. So there was literally tax on tax, and they had that cascading effect. When GST came, it was a nationwide tax system with provision for availing input tax credit across the country. And flexible inflation targeting was intended to ensure price stability. So these two major reforms, acting in conjunction, have actually made Indian economy far more efficient than it was earlier. The track record of flexible inflation targeting has been very robust. Till the COVID-19 pandemic, the average inflation from 2016 to 2020 March, the average inflation was just 4%. Actually, it was 3.9%. After the pandemic, naturally, suddenly the prices went up. The all-round inflation went up very high because of obvious reasons, and then Ukraine war. But even in this situation, it is only because we have a flexible inflation targeting, we had the flexibility, we utilized the band around the target, that is 4% plus minus 2. We utilized that in this period, in these periods of crisis, to first, when COVID hit the economy, when pandemic hit our economy like any other country, the Monetary Policy Committee decided to cut interest rates. And when we moved towards higher inflation, the Monetary Policy Committee immediately changed its stance and started raising interest rates. And in parallel, we adopted, concomitantly, we adopted suitable liquidity, liquidity measures also to keep the level of liquidity appropriate and in consonance with, in sync with the interest rates. So therefore, flexible inflation targeting has really proved its mettle in India. It has enabled us to deal with the multiple shocks that we have encountered in the recent years. It has gained a lot of credibility in the eyes of the common people. Today, everybody is fully conscious about, about inflation targeting. And again, it is only because of the inflation targeting, policy, that the inflation targeting framework that we have, backed by the communication that we have been doing. From September 2022, the household inflation expectations are constantly going down. Almost in every round of our, household inflation survey, the inflation expectation, household inflation expectations are going down by 10 or 20 basis points. And it is happening consistently over the last 2 years. So it has also therefore enabled us to anchor inflation expectations of the households. So just to sum up, it's a major structural reform. Together with GST, it has made Indian economy far more efficient, because the cost of production, once there is price stability, investors have greater confidence, both domestic and foreign investors have greater confidence. The economy has become efficient because high inflation would mean very high interest rates. So interest rates, we have therefore kept it at very reasonable levels in line with the inflation. GST also has reduced that tax on tax and the cascading effect. So cost of production overall has gone down. These two major reforms have acted in conjunction. So at the moment, inflation expectation is very much embedded into the Indian soil, and I do not expect or foresee a situation where India will move away from this major reform that has been embedded into the Indian soil, and it has gained a lot of credibility over the years. Now, talking about, you asked about the food inflation part. Now, there is some, discussion going on in certain sections about whether food inflation should be a part of the inflation targeting. Now, internationally, you know it better than I do. I mean, you have done so much of work on flexible inflation targeting, and there are other eminent, academicians and economists here who also know very well. Now, world over, inflation targeting is the headline inflation.
Right.
Only, I think, as far as I know, among the major economies, it's Japan
where the inflation targeting is headline minus perishables. Minus perishables.
Fresh food and
Perishables will basically mean certain vegetables and maybe milk or milk products. Otherwise, world over, the target is the headline inflation, and for a good reason. Because households and a common citizen, he understands overall inflation. And if you take out food inflation and you target only core inflation is something which the average citizen just doesn't understand. And his expectations are determined by the groceries he buys, the vegetables which he buys, the electricity bill he pays, the gas bills which he pays. So therefore, it is his daily expenditure which influences his thinking, and particularly his expenditure on food items. In a country like India, where the food component in the CPI basket is 46%, if you keep out food inflation, then it is as good as not having a target. And it will lose credibility in the eyes of the people, because a common citizen will just not understand. On the one hand, you would be saying that we have achieved our inflation target, core inflation. But an average citizen will say, sorry, I mean, what is this core inflation? I'm still paying a very high electricity bill. School fees have gone up, house rents have gone up. So therefore, inflation has to sort of be headline, and it has to be reflective of the components of the household consumption basket. You can't just segregate one large part of the consumption basket and say that I will target only this. India has, as I mentioned just a little while ago, let me reiterate, inflation targeting has gained a lot of credibility in India. It enjoys a lot of public trust, and it will remain. I don't foresee a situation where there will be any change in component, but there is a survey now going on. The National Statistical Office, this CPI basket, the relative weight of food and core and other components, this is determined based on a very old statistics. So now the fresh round of survey is going on. 2 years of survey are almost over. And sometime, I think next year or next to next year, we expect the new consumption basket to be announced. In that, it is quite possible that the food component might have come down. Now, if the food component comes down, then naturally the CPI will reflect, whatever is the consumption basket of the average citizen. So to sum up a long answer, sorry for that long answer, flexible inflation targeting today enjoys a lot of credibility, a lot of public trust. It will remain. Targeting core inflation without food inflation will make no sense to the average citizen. He will just not understand what we are talking about. And it's for good reason that the target is headline inflation, and it is the headline inflation which the average citizen, which the common person understands, and it should be that way.
Thank you. I think we have time for one question there at the back mic, please.
Thank you very much, Nicolas Veron here at the Institute. My question is about international payment systems and your vision for India in the global environment. This week, we also had the BRICS summit in Kazan. There was an announcement of a work stream, if I understand correctly, of thinking about the common infrastructure that would serve the BRICS countries. There's a lot of attention, as you know, on the M-Bridge project, which has been pioneered by the Bank for International Settlements in Basel, and also some indications of possible political controversy about the role that China is playing in there. So how do you see the global payments architecture, the role of SWIFT, of CLS, of these new projects going forward, and how does that connect with the debate on fragmentation? Thank you very much.
You see, our current effort, and so also the effort of the BIS, our effort is to link the fast payment systems across countries. In India, we have the UPI, the Unified Payment Interface, the UPI. UPI today, per day, the number of transactions are, per day transactions are about 500 million transactions are done in the UPI per day. And that works out to roughly 5,800 transactions per second. India is a huge country, so 500 million transactions per day is quite a huge number. And in fact, just about a year and a half ago, it was 300 million transactions, and it has now grown. Our current effort and the effort of other countries, as well as the effort of BIS, is to develop fast payment systems in individual countries. Many countries have already developed their own fast payment systems. Brazil has its own fast payment system. Singapore has it, and several other countries already have it. Our effort is to try and link these fast payment systems across countries. Our UPI is currently linked to fast payment system of Singapore, which is called Pay Now. We have also linked it to the system that prevails, the fast payment system of Mauritius. And gradually we are linking it to other countries. QR code-based payments made on the UPI platform are now installed in countries like countries in our neighborhood like Bhutan, Nepal, Sri Lanka, and countries in our region. And we are also in discussion with several other countries to link our fast payment system with the fast payment system on the other side, so that and this is for retail payments, not for trade settlements, it's for retail payments. The effort is to see that payment system becomes much faster, especially it will be very convenient for business travelers and for tourists. The other effort that is happening is under the aegis of the BIS. Recently, the ASEAN countries and India, we signed an agreement to move forward on something called the Project Nexus. Now, Project Nexus is an effort to network the fast payment systems of India and these 5 ASEAN countries. So BIS is also trying to do similar, initiatives in other parts of the world. So first thing that is happening is to link the fast payment systems, and it is mostly on retail payments. It's not relating to trade settlements or anything like that. The other area where currently effort is underway, where we have, I think, made good progress and other countries are also experimenting on it, is CBDC, Central Bank Digital Currencies. And we have launched our Indian CBDC, which is called the e-rupee, under a pilot mode. It's now a pilot project which is going on. Eventually, as I see and as central banks across the world, as all of us see, I think CBDC has the highest potential to make cross-border payments very efficient. It will make it, it will improve a lot on time. It will be in quick time. It will be almost instant, low cost, and highly efficient. But CBDC is still quite some distance away because every country has to adopt CBDC. So that exercise is going on. So this is with regard to the retail payment systems. Now you talked about SWIFT and all that, in the context
of BRICS.
in the context of the BRICS, etc. Currently, the SWIFT still remains as the major, messaging system across the world. And efforts are now made naturally by many countries to develop their own modes in that direction. But I think currently, as things are operating, the payments are made by, the trade settlements are done by commercial banks. And it is bank to bank, bank in one country vis-a-vis the bank in other country, and the messaging system, the standard messaging system which prevails today, are being used.
Thank you very much. With that, again, the governor has exceeded content per second, even by the Peterson Institute standards, just as he talks about how many transactions in the billions there are daily in India. I hope this is the first of future occasions when we will be able to welcome the governor and leadership of the Reserve Bank to the Peterson Institute. Please join me in thanking Reserve Bank of India Governor Das.
Thank you.